All right, so today is Wednesday, February 7th, 2 p.m. section. We are recording on. We're going to talk about the key value driver simulation that you just went through. Okay, so as I said, if you understand these 6 scenarios at a high level beyond this class, you'll understand kind of what's going on with any company in terms of the kind of value creation models related to the key value drivers. So in terms of the sim, as I said, you went through these scenarios and you changed the values in this spreadsheet. And just kind of resetting the data here for a second. So the first thing that you were supposed to do, sort of scenario number 1, is you change the expected profit. 200, 300, up from 100 million. When you change the profit, what happened to the value and what happened to the multiple of each of the companies? Yeah.
Value increase by the amount you increase profits, numerically by the percentage.
So 100% profit, 100% value, basically?
Yes.
Okay. What happened to the multiple?
Remain the same.
Why? Why did the value go up and the multiple stay the same?
Because value increased by the same margin as the profit.
Okay, but why did the multiple change? Yeah.
Because the profit doesn't have an impact on the actual low-rate formula. You don't really, the multiple is more based on the expected ROIC and the cost of capital than it is on the actual profit.
Okay. So I'll say it simply beyond the math. This is an example of in finance what we call sizing. You are bigger. Okay? You're more valuable because you make more money. You just have more absolute NPV. But you're not better. Okay? You don't have a different IRR. All right? You just have more NPV. Right? So that's one way to create value. Just size. Just generate more cash. All right? But the other element is the better element, which is the multiple. Do I pay more for those cash flows? And that's where the other 3 factors come in, right? What's going to cause people to want to pay more for a company's value, higher multiple, higher PE, is if the long-term growth changes, the long-term business model ROIC changes, the long-term risk changes. Those are the 3 factors that drive multiples. In fact, that's all a multiple is. It's just a representation of future growth and future spread. Okay, so if your future growth and future spread don't change, your multiple doesn't change. So those are the 2 factors that affect valuation. Right? So let's now get into scenario number 2, and let's start talking about what's going to change and affect the multiple. We're now going to change some of these longer term factors. All right. So it's not just one-time increase in earnings. Like, I'm a business, I am Walmart, right? And I go bigger into Latin America with my low-cost model, okay? So I'm not going to change my ROIC, but I'm going to get a lot more growth, right? What happens when the company grows, but we don't change the ROIC of company A? Just start growing those earnings faster. So instead of 100, 105, 110, we're now 100, 108, 116, ... What happens to the value? What happens to the multiple? Nothing? Why not?
Because it doesn't matter how much you grow if you're netting nothing.
It doesn't matter how much you grow for what?
If you're netting like no money.
What do you mean by netting no money?
Like their ROIC is the exact same as their WACC, so even if they're generating more money, they're not pocketing at the end of the day.
Yes. So in my language, they have zero spread. If your ROIC and WACC are equal, you're not, his words, netting no money, you're not creating any value, right? So it's basically saying, I have a 0 NPV, and I'm going to do a bunch of 0 NPV projects. You keep adding up 0 NPV projects, you get 0 NPV, no change in value, okay? And so I'd like to call this scenario the treadmill, okay? You basically get on a treadmill, you run really fast, you don't go anywhere, and you just get tired, okay? And a lot of companies get on this treadmill, and they're just like, hey, I'm growing, I'm selling more stuff, my earnings are going up. Why am I not getting credit for that in my share price? And the answer is because you're not beating your cost of capital. You're spending too much for that growth, and it's not good growth. That's why I said growth is the accelerant here. Now, does that change in scenario number 3 for company B? Like when company B starts to grow, does the value and multiple change? Why? because you're growing a positive spread. If I can borrow at 10, make 20, I want to do that all day long. And the more I do, the more valuable that I get, right? This is kind of like the nirvana that everybody is searching for when it comes to valuation. This is NVIDIA right now, okay? NVIDIA is just dramatic growth in their market. They're selling a lot more chips. They're making huge margins in every chips. The more they sell, the more they make. All right, and this is just the value creation. And that's probably not going to change in the next 4 to 5 years. So it's just a really good place for NVIDIA to be right now, but it's because they're growing a very high spread. All right. Conversely, I'll show you an example of the opposite. So if we go to a company called Merck, MRK US Equity, big pharmaceutical firm. As you know from your Bloomberg certification, FA is historical data. And we can go to FA Custom, and just like under RV, where you do benchmarking, we can look up any data point on a company, income statement, balance sheet, cash flow, historically. So what I'm going to do is I'm going to switch this to 12 years, 12 periods, historical data. And the data I want to look up is ROIC, return on invested capital, and WACC. So this is Merck's ROIC and WACC for the last 12 years. Okay. So scrolling over here, here's the idea. If you have a positive spread, if your ROIC is greater than your WACC, you're creating value, your stock price should be going up. If you have a negative spread, if your ROIC is less than WACC, you're destroying value, your stock price should be going down, negative NPV. And if you have a break-even spread, zero spread, you should be flat, stock price should stay about the same. That was scenario number 2, the treadmill. Okay? So I want you to envision a line chart from 2012 through today of what their share price looks like. Okay, so tell me what's going to happen to a line. We're going to draw a line. So between 2012, 2013, line going up, down, staying about flat. Maybe down a little. Between 13 and 14, up, down, flat. Maybe down a little more. Between 14 and 15, bounce up a little. Actually bounce up. You're going from negative to less negative. Okay? From 15 to 16, maybe bounce down a little. 17, maybe hit the worst. But here's the point. Between 2012, 2017, kind of bouncy, flat, not really going anywhere, got some dips, but no big surges. That's what we would expect according to the data. All right? And the reason I chose Merck is because the third factor is growth, and they really haven't grown much during this period. Their growth is very low single digits. So because growth for them doesn't matter that much, it's really about their spread that's driving the share price. Now, if growth mattered, they're growing 15, 20% a year, this would be a different story. So going back, what happens to the share price between 2017 and 2022? Do you think that share price is going to start going up again? Almost like a 45-degree angle? Well, let's see. GP is graph price. This is a graph of Merck share price, defaults to a year. I'm going to switch this to 2011. So from 2011, February 2011 through today, that's the new line. This is what you just told me it was going to look like. You told me this line was going to look like this line. And that's exactly what it looks like. It's pretty flat with some dips, and then starts surging when the ROIC starts to surge. Because that's what we expected. When you generate more cash, you're worth more. When you generate less cash, you're worth less. Matter of fact, you can go over here on the right where it says add data, ROIC. The blue line is the ROIC. The white line is the share price. And you'll see it's fairly correlated. And the reason why is because growth is not a factor. If growth were a factor, it'd be a little bit trickier. That's why I'm picking Merck, right? But what I'm just saying is this is the difference between scenario 1 and scenario 2. The treadmill, kind of growth at zero spread or close to zero spread, you're pretty flat. When you have a positive spread, your share price tends to go up. When you have a negative share price, your share price tends to go down. That's what we would expect mathematically. That should play out with companies. Yes, sir?
Are you going to add a spread line?
Well, short version is I can, you can't. So homework 4, once you finish your Bloomberg certification, is going to involve creating custom formulas in the Bloomberg terminal. So as many formulas are in here, data points, you can create your own. Okay? And so spread is not a technical term they use in Bloomberg, but I have a formula called spread, ROIC minus WACC, but you don't. But after homework 4, you will. So yes, you could. But for now, you're just going to be looking at the difference. Other questions about this? But these are two important scenarios. All right, back to our simulation. Scenario 3, or actually 4. 1 is sizing, just make more money. 2 is treadmill. 3 is, need a better term for this, but kind of your nirvana, great growth, great spread. Value creation is exponential. Scenario number 4. Okay, this was the reset that you did in the simulation. Basically what I had you do is take company B, which has high spread and high growth, and start slowing the growth. Maintain the returns, but slow the growth. Okay, so instead of 8% growth, you get 5% growth, you get 3% growth, you get 2% growth. As the growth slows, what happens to the value? What happens to the multiple? They're both decreasing. This is the expectation cornerstone at work. I price you as if. I price you as if you're going to make 20% and you're going to grow that 20 cents at 8% a year. I realize I was too optimistic. You're going to make 20%, but you're only going to grow it at 5% a year. That's worth less. Everybody see that? So there's going to be 2 reasons this happens. Number 1, companies mature. Right? Markets mature. This is the idea that over time your competitive advantage doesn't last forever. And as you regress to the mean, the high-flying companies, think NVIDIA, are not going to be as high-flying forever. And so eventually, as their returns start to come back to earth, so will their multiples. Reason number 2, law of large numbers. As you get bigger, it is harder to grow at the same rate. Growing 10% when you're a $10 billion company is a lot easier than growing 10% when you're a $100 billion company. Because 10% of 100 billion is 10 billion. Okay? 10% of 10 billion is 1 billion. So as companies get bigger, it's actually harder for them to grow at the same percentages because of law of large numbers. So their growth rate naturally comes down. Well, that's actually going to mean their multiples are going to come down as well. And it doesn't mean they're bad. It's just different because they're bigger. Yes?
Is that why Meta offering dividends could be seen sort of as a bad sign because they're slowing down the growth?
Correct. Because they don't have, Meta being Facebook, basically they don't have the growth opportunities. And part of the growth opportunities you can see here in Bloomberg. Just go to Bloomberg Meta. And EEO is a good summary screen using revenue as a proxy. When you're a $135 billion company, it's hard to grow 30% a year. Right? This is back to the sizing issue. So Meta growing from 156 billion to 175 billion, that's actually pretty impressive. But if I switch these to percentages, that's a 12% growth rate. Right? So that's what I'm saying. It's like when you're a $50 billion company, it's still hard, but it was easier to grow 20, 30% a year. They're so big. This is the law of large number effect. Your growth starts to slow. So what that scenario tells us is if I have a high return but a slowing growth rate, my multiples should start to come down, right? So here's the point. Let's look at price to earnings multiples. Here are forward PEs. And by the way, this is more important to price to earnings multiples than historical PEs, right? Because who cares about your historical PE? It's irrelevant. Like, I don't get your historical cash flows. I get your future cash flows. So what I'm going to pay for the future cash flows is far more important than what I paid for last year's cash flows, right? So that's the point. You're going to start using this data, especially with the section 4 of the class. But here's how PE is created. So this is Meta's earnings per share for 2024, $19.43 a share. That's the expectation today. Here's the share price, $468.28. Take $468.28 divided by 1943. That is a PE of 23.97. Here's next year's earnings. 25 earnings, 22.23. Share price divided by next year's earnings, PE falls to 20.6. 468 divided by 26, PE falls to 17.6. As you go further out, multiples start to contract. Now, mathematically, if I have the same share price today and my earnings grow, that will be a lower multiple. But that's actually a fallacy that you're taught in your previous finance class, right? Here's what I mean. What a lot of people are taught in like Finance 301 that they bring at other schools to the real world is they say, oh, my PE last year was 31. Okay? Current share price last year, 12 months worth of earnings. So I'm trading at 31 times earnings. So that means if I get $1 per share of earnings growth, my share price should go up by $31. That's the whole point of PE. But is it actually going to go up $31 this year? If in 2024 they get $1 EPS growth, how much is the share price actually going to go up? $24. And if they get $1 growth in 26, it's going to go up $20.60. Share price isn't going to keep going up $30 a year. So that's where people make mistakes. They'll overvalue a company because they'll use the historical PE. The forward PEs are lower, right? And mathematically, there have to be, right? Conceptually, because if you're growing at a lower spread, you're not going to be as valuable. You're going to have a lower multiple. The other reason is just mathematically, if you have the same price, same value, and your earnings go up, price stays the same, earnings higher, that's a lower multiple. Okay, those two things are working against you in the real world, and this is where people make mistakes. So there's two mistakes people make. One, they'll overvalue a company like Meta because they'll mistake the current PE for what it's going to be worth in the future. And two, they'll look at a company like Meta and a company like Apple, and they're like, oh, Meta's PE is 24. Apple's PE it's a good example. No, not a good example. I'm going to look at Google's PE. Okay, Google's PE is 21. And then 17 or 18.6, then 16. So consistently a little bit lower than Meta. So what some naive person, who's probably a billionaire, would say on CNBC tonight is, oh, you should buy Google because they're on sale. If you look at Meta's PE and you look at Google's PE, Google is cheap. So buy more Google. Okay? And I'm telling you that's a fallacy. And the reason why Google's cheap is because Google's growth return combination is lower. And so if Google has lower growth than Meta for a high return, they're going to trade at a lower PE. So they're not going to just go to Meta's PE unless Google increases their growth rate. What's more likely is as Meta's growth rate slows, they're going to start looking more like Google's PE. But they're not just going to trade the same because PEs are a function of growth and return, growth and spread. Does everybody kind of follow that? But that's that fourth scenario. That's the scenario of slowing growth at a high rate of return. Okay? So let me show this how it plays out. So last week I was doing some work with a company called Amgen. Had a bunch of senior leaders in a webinar that I was teaching them, talking about value creation, their share price. And so on Monday, they reported their earnings Monday night. And we were talking, and I don't have any confidential information I'm sharing here. Everything's public. But I was telling them what Wall Street was thinking about their earnings call. And prior to their earnings call, I sent them a summary of what the analysts were going to be looking for during the call, what they were going to ask them about. And what the analysts were saying Monday morning, before they released their earnings at the end of the day, that the entire earnings call was going to be focused on a drug called ABB-133, which is in stage 1, stage 2 clinical trials. And the readout from that clinical trial is going to be really important to Amgen's earnings and all the models. Because on a sell-side earnings call, when Amgen reports its earnings, they're in a conference call with all the analysts, okay? EVT. So I'll go to Amgen. By the way, here's Amgen's share price today. You want to guess how that call went? Okay. So here's EVT. And this is the event calendar. So this was the call. and happened at 4:30. Matter of fact, if you actually go over here, these icons, this is the transcript. So if you click on this little icon off of EVT, off the earnings call, Bloomberg, during the call, is listening in and transcribing the call in real time. So you can actually, without listening to the call, you just go to your terminal and you can actually hear any earnings call of any company. But as soon as the call's over, you can see the complete transcript of every earnings call of every company. And they're searchable, by the way. So this is the call. And basically, if you read through the transcript of the call, and you can download this as a PDF, company talking, blah, 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 who really cares? I'm bored. It's just a press release. I can read. Yeah, you're talking about your great future, yada, yada, yada. Now I can ask questions. Okay, so these are the analysts, and these are the questions. So let me get to the questions. Where are the questions? Blah, blah, blah. Do they not have questions? All right, here's the questions. Finally, questions. They talked for a long time. So Jeffries, first questions. I hadn't seen this transcript, but I'm guessing what the first question is going to be. So Michael Yu Jeffries gets to ask the first questions after they rambled on for like 30 minutes. And his first question is this. Hey guys, good afternoon and thank you for the good results and good guidance. We have a question on obesity on 133. So that was the point. All the analysts were just waiting to ask about 133. Do you know why they wanted to ask about 133? And I'll give you a hint. The word was just in front of it. It's an obesity drug. It's an Ozempic competitor. Okay? And if you look, EEO, these are their forecasts. Some from the models, company specific. Down here, these are all their drugs by sales by drug. But if you go down near the bottom, this is their pipeline. This is it's AMG 133, which launches in 2025, 330 million, and then goes on. And so the whole point is, I showed you data about how much revenue Novo Nordisk through Ozempic and Eli Lilly with Mounjaro and their other GLP-1s we're going to sell. We're talking like 70 billion a year. And so Amgen has a third drug that basically does similar stuff for weight loss, but it's in early stage clinical trials. And so they were going to report out yesterday to the market like how successful their early stage data is. Let me let you talk about what do you think the answer to that question was. It wasn't so good. Okay, it wasn't like they're not going to get approved, but it wasn't as effective as everybody thought it was, and it wasn't moving through as quickly as it was. Well, if you have a drug that's a Me Too drug that's not as good as the stuff out there, you think you're going to sell as much? No, that's the disappointment. Okay, that's only one drug in the early stage of their pipeline, but that was the point. Like if I'm thinking about Amgen, and I'm trying to model out all their cash flows, what I'm going to see for Amgen is an existing portfolio that's not going to get as big as I thought, and if it's not going to be big as I thought, then I'd cut your cash flow estimate. So here's what they did after the call. They sit there in the Q&A to ask their questions. They hear the answers. They basically hear, we're not going to sell as much. So they went in, you know what this red line down means in the EEO screen? What does an arrow down mean? That's red. Yeah.
Revised estimate.
Revised estimate down in the last 30 days. Green arrows, revised estimate up. They revised their EBITDA forecast for the next 4 years down because that drug isn't going to be as successful making as much money. Now, Amgen's still going to make EBITDA of almost 18 billion a year, which is pretty darn impressive, but it's not going to be as high as they thought. So that's the whole point. If I get less growth in those earnings that are still pretty high, then this is the cornerstone at work, share price is worth less. I'm pricing you lower because the expectation went down. Yes?
Can you tell how much it was revised by?
Yes. If I click here or hover here, the box pops up. The average 4-week change was down 882 million for that 1 year. So basically they lopped off $1 billion worth of earnings on average across all these analysts just in that 1 year. So instead of 18 billion, it should have been almost 19 billion. But do that every year and you get a lower share price. Okay? And if you get a lower share price, A&R, then the target share prices which were higher than the current share price, equal the current share price, and there's no upside. So you make $19 billion a year and the market doesn't think you have any upside. Why? Should be obvious to you, but why? Yeah.
Your ROIC is not equal.
No. This is the other issue. Yes. It's the lowering the growth, but why does the share price not matter? Here's the secret to your Bloomberg trading challenge. I want to be very specific about this. This is what most finance people get confused about. I'll help you. Everything you've been taught so far, and most people understand the real world, is you've been taught absolute performance. Over time, you absolutely have to generate cash. Over time, you absolutely have to have a positive spread. Over time, you have to make NPV. You can't create value otherwise. And that's how we judge. Over time, you got to make money. All right? That EEO is basically saying, here's your share price. That's the baseline wisdom of the crowd of the professionals on Wall Street forecasting a company. They're forecasting revenue, they're forecasting profit, and from that, there's a forecasting of cash flow. If I know the forecast of cash flow and I know the discount rate, the WACC, I know what those cash flows are worth today. That's called your share price. I'm simplifying, but that's what our math is working towards. That's what we're going to be doing this semester. Tell me what the cash flows are, tell me the risk, and I'll tell you your share price. Okay? Different ways to get to the math, but it's all leading to the same answer. You're worth the sum of your future cash flows. There's the baseline of the future cash flows. That leads to the share price. Those cash flows lead to the $300 share price. So what would cause the share price to be higher? What would cause the share price to be 330, not 300? Conceptually. How does my math justify a 330 share price versus a 300 share price? Yeah. Expectations of the cash flow are what? They had to be better than this. If the cash flow expectations are better than this, they turn out to be better than what's on here, share price should be higher. If the cash flow expectations are lower than this, the share price should be lower. Here's the point. Relative. You are also judged on relative performance, not just absolute performance. Once there's a target, it's performance against plan. Did you do what you said you're going to do? Did you meet this target? If you miss this target, then the share price is going to adjust. Right? If you beat the target, the share price goes up. If you miss the target, the share price goes down. That's your opportunity in the Bloomberg Trading Challenge. Right? The Bloomberg Trading Challenge is about expectations. Right? Because there are prices for all the companies that you're buying. So the question is, does the market have it right? Because the market has it right, then you're not going to make money in the Bloomberg Trading Challenge. You're going to make money if the market doesn't have it right. That's what happened to Facebook, Meta, last Friday. Basically, real smart people got in that conference call, and Zuckerberg and his crew at Facebook said, you know, guys, we're kicking ass, and we're doing a lot better than you thought. And we're going to be kicking ass and taking names for a lot longer than you thought. You don't understand how good it is. Let's talk to you about it. Oh, those are much better numbers? 20% increase in share price. That's what's going to drive the share price. It's an expectation game. What happened with Amgen? Amgen, there were high expectations. Oh, they have the third obesity drug. Obesity is like the fastest growing drug out there. It's this giganto market. Great. Let's hear about this exciting drug and exciting news in this giant market. And Amgen's like, well, we don't have such good news on our drug. You know, you could hear the balloon deflating. Okay? And it's not that they're doing poorly. It's just they're going to do less well than the hopes. And that's why the share price went down. So maybe new data will come out and it will be better later, and then the share price will adjust. But that's the point. Where you're going to make money in your Bloomberg Trading Challenge is right now, when there's new information coming out in earnings season. Because if it comes out to expectation, nothing really happens in the share price. If expectations are better or worse, that's what's going to drive the share price. That's your opportunity. If you knew that Meta was going to do better than the market, you could have made a killing in the first week of trading in stock tracking. You would have made 20%. You would have won the game. Game over. You put $200,000 in Meta before Friday morning, you'd have won the first half of the semester. Now, nobody did it. But that's what I'm saying. Like, that's your opportunity. So the real question is, how do you figure out when the market's wrong? That's the hard part. because you're dealing with some real smart people out there. What I'll tell you is you need the outliers, right? And I was kind of saying this to the class earlier, but like, if you're putting all your money into Home Depot, you're probably not going to win the stock track competition. And here's what I mean. Like, Home Depot is not going to surprise, and suddenly everybody's going to realize that they're going to sell 20% more than they've ever sold before because nobody figured that out. Like, there's just not going to happen to Home Depot realistically anytime soon without a gigantic acquisition. So their sales are like, oh, we're selling 5% growth, and maybe we're going to get to 6% growth. Like, that's what they're fighting over, right? So yeah, you're going to make a little bit of money, but that's the argument you're making, and you're doing it with some really smart people that are tracking Home Depot. Like, what you want to find is something that has a big opportunity to be different, because that's where stocks are really going to move. I don't know what they are, because if I did, I wouldn't be in front of you, right? Because we're dealing with the future, and we don't have access to inside information. Like, when I was on the call, my webinar with the Amgen people, not a peep about what was going to go on with AB 133. They couldn't tell me, and I wouldn't want to know. That would be insider trading. And even if they did tell me, one, I wouldn't be using the story with you, and I couldn't have traded on it, right? But the point is, like, unless you do something illegal, you're not going to have information in front of the market. In fact, it was funny that there was a headline today in Bloomberg that Citadel has been getting information about Morgan Stanley's trading data. Like, that's the type of stuff you got to stay away from. Like, that's the Gordon Gekko Wall Street stuff. But the point is, if you can figure out that, hey, the market just doesn't have it right, that's the opportunity. And that's where another example, Tesla, comes into play. What's been going on with Tesla in the last week and a half? Yeah. I'm sorry? Yeah, what's causing their share price to be not good? What's been in the news about Tesla? What?
The Cybertruck.
So Cybertruck has been what?
It's been like rust and the wheel covers have fallen off.
So quality issues making the Cybertruck. What else?
Like the lower growth estimates.
It's the lower growth estimates. By the way, Musk has also been in the news because he got the board, which is basically, I think, his brother-in-law and a family member, to agree to give him $50 billion of compensation for 1 year for the great job he has done. And a Delaware court said, no. Like, that is just completely unreasonable and an abuse that we're not going to let happen, because you're basically robbing your publicly shareholders and taking all their money and giving it to yourself. We're not going to let you do that. So that's why Musk is like, well, I'm just going to leave Delaware to go to Texas where they don't care. Okay? So they're literally going to move the company to Texas so he can rip off the shareholders and steal $50 billion for the company. That's the next fight at Tesla. And then the fight is over the board, because his board's a bunch of his friends who he has also enriched. So basically he's like, you know, I'm going to give my money in the $50 billion to you if you approve my $50 billion. And it's very incestuous. It's really ugly what's going on there, and just it's awful. I hope it's not allowed. But that's not the story about Tesla right now. The other story is the more sales. I saw another headline this morning. Didn't read it. Just saw the headline fly through Bloomberg that last month Tesla sold one car in Korea. Think about that. One car in Korea. Now I know the Koreans are making really good electronic vehicles. It's very competitive there. And I know in China that there's a company called, was it BYD, that's making very low cost electric cars that are pretty high quality, much cheaper than Tesla's. And so we were talking about this last week. Like, the problem that Tesla's having is growth. That going from the early adopters to more the early majority, they're struggling. It's not that they're going to grow, it's just they're not growing as fast, which led to the headline this morning. The headline this morning is that the people at Tesla are going around asking who are the critical workers. And they're trying to decide which of their workers are critical. Why do you think the company's asking who critical workers might be? What's that signal of? Layoffs. So now the rumors are it's going to be layoffs at Tesla. And in the US, if you have more than, I think it's 200 people, and you do layoffs, you have to announce it. You can't just go lay off people. You have to give them 30 days notice before the layoffs start. So you're going to see Tesla likely announce layoffs pretty soon. And here's why. EEO. See it right here. After their earnings call, and they basically started giving guidance because they've been lowering their price and lowering their volumes. You see all those red arrows? This is the next 4 years. This is the third scenario that we just went through, playing out in real time with Tesla. Because less sales at less volume, at less profit, less cash flow, lower price. So when they went from 240 to 189, that's why. This plays out in the real world. That's what I mean. If you understand what's going on here, this little model, you can relay it to what you see happening in the real world. That's exactly what's happening right now with Tesla. It doesn't mean they're not going to grow. They're going to grow. They're just not going to grow as much. And they're going to grow at lower margin. So again, it's not that they're going to have more margin. It's just not as much as was expected. And if I have less sales and less margin than expected, I have less cash flow. And if I have less cash flow, I have lower value. You saw that in your key value driver set. Questions? Make sense? All right, the next scenario you would have done in the sim. Excel is we would have changed company A to a negative spread. ROIC of 8, WACC of 10. What happens when you grow the negative spread? The more you grow, the worse it gets. Because if I borrow at 10 and make 8, the faster I grow, this is actually really bad growth. You know, hey doctor, my head hurts. Why does your head hurt, Mr. Perfetti? Because I've been banging it against the wall. Well, maybe you should stop banging it against the wall. So what's the solution to a company that's growing a negative spread? Yeah, stop banging your head against the wall. Stop growing. And that was what I showed you. Like if you made your growth 7% to 5% to 3% to 0% to negative 3%, shrink, sell, lay off, exit, cut your budget. Don't do the bad stuff. And you'll actually create value because you're not destroying as much. Right? So destroying less value is actually creating value. So don't fund the negative spread. Now, I'm not saying that you don't fund a negative spread in the short term that turns around to a long-term value, but that's the point. If the plane's heading down and you're going to crash, jump out of the plane. Put the parachute on. Don't just follow the plane all the way into the ground. Right? Don't just take the shareholders with you. Like, give them an out before you waste all that money. And so I'm saying this is that final scenario for the scenarios. And so this is the really bad situation. Treadmill, Nirvana, maturing company, just kind of the value destroyers. Questions about this? All right, final scenario that you did, reset, is I had to change the WACC. What happened to A and B when you increased the WACC to 12? What happened when the WACC went to 12? Why? Spread's less positive. But that's not the reason it went down. It's actually a more important factor. It's not that the spread went negative. It's that the discount factor changed to 10 to 12. Why does that matter? Yep. All the future cash flows are worth less when you change the discount factor. People underestimate how that plays in evaluation. The opposite's true. Watch this. I'm going to go 10, 10. Okay. And I'm going to go 12 and 12. Notice that 12 and 12 is worth less than 10 and 10. Notice that 8 and 8 is actually worth more than 10 and 10. Because it's not the zero spread. It's the fact that when I discount the cash flows at 8% and I discount the cash flows at 10%, 8% is actually drives a lot more value because I don't have to discount the cash flows as much. And I'm telling you, people underestimate how much discount factor affects multiples and valuations. That is the stock market today. Okay? In fact, let's see if the headline's still there. Bloomberg, top news. It was there when the class started. S&P 500 near 5,000 as stocks climb the wall of worry. Why has the market been so good for the last 60 days? Yeah.
Because they were thinking that discount rates were going to be decreasing as a result.
Why are discount rates expected to fall?
Because the cost of lending, or cost of bank lending is supposed to, federal lending
Why though? What's causing bank lending to go down? What's causing interest rates to go down? What's causing cost of capitals to proceed to be lower? Yeah.
Like the economy's doing well, so we're more expecting like interest rates to be.
It's not just the economy doing well. What's driving interest rates lower? Lower inflation. Inflation drives interest rates. And if inflation's down to 2%, which is where the Fed said it wanted to be, well, I don't need to have 5% short-term rates and 4.5% long-term rates with 2% inflation. There's an expectation by the market that interest rates are going to come down. That affects everybody. So if interest rates come down, the market goes up. That's the trade. That's exactly what's happening today. Okay? Now, here's the danger. That's priced in. Before the interest rates have actually fallen, the market has anticipated them and priced them as if they have fallen. If the interest rates stay higher for longer, you could actually see some real tough times in February, March, April, because people's expectation got too aggressive. See, that's the Bloomberg trading challenge. Like, did the market get too far too fast? Maybe the interest rates are going to get down more aggressively and they didn't figure this out fast enough and there's still more upside in the stock. But that's the uncertainty of the macro market. So we have individual factors to stock, we have macro factors to stock. You have different ways to think about this, but if you can figure this out, forget the clash, you can make a killing. That's what Wall Street's looking for. That's alpha. Part of the reason why we do EIC, okay? Because if you're paying attention to the external market, not everybody's paying as much attention. And so that's what I'm saying. You can make some money if you're kind of paying attention and then almost predict the way the news is going to be. If you're paying attention to what's going on social media, like a lot of what's happening with Meta may not have been as much of a surprise to you. Okay? Matter of fact, right now, personal opinion, not saying it's going to happen, I'm not liking the news I'm hearing about Apple. I mean, they're betting a lot of money on, what the hell are they calling this? Spatial computing, that nobody can figure out what that means. It's just their marketing term for, what did the Facebook thing? Yeah, the Vision Pro, which is the headset. And basically, the people that are testing it are like, you guys are old, or I'm old, you're young. There was a movie called Big. Did you ever watch the movie Big? It's probably on Netflix. Really good movie. It's about a kid, Tom Hanks, who was like 12 years old, wakes up, wishes he was 30, and wakes up, he's 30 years old, but he's still a kid. Anyways, he starts working for a toy company. There's a really good scene in the movie where, because he's still a kid, even though he's an adult, they're testing toys, and he actually has the kid's point of view on the toy. He's playing with his toy, that everybody's like, ooh, this is the next big thing. He's like, I don't get it. Well, to me, that's Apple. The way that the people are talking about the Vision Pro is the people that are testing it, the hardcore Apple enthusiasts. I don't get it. I don't see how people are going to use this. I don't see the real benefits to this that are practical. Like, it's got a couple of cool features, but the general consensus out there that I'm reading about, I don't get it. And it's $3,500, by the way. So I'm just saying, I don't think that that's going to be their next engine of growth anytime soon. And they don't have a lot right now that's driving iPhone sales higher because everybody's already got one. And it's just replacement cycle. And they keep getting more and more expensive. So the point is, what's the catalyst that's going to drive Apple higher, right? And so I guess that's the point. Like, if you don't see that, what's going to happen over the next 3 months with their earnings when there is no iPhone coming out, but as people are trying to absorb this, that negative sentiment, I think, is going to start weighing on Apple. And as good as it's been the last 2 years, I don't think it's good anymore. That's my opinion. I could be wrong. It could keep going up. But you can see what the earnings estimates are, EEO. And so the question is, you absorb all the data, are they going to hit these targets? Because that's the next earnings call. But you'll also notice for Apple, these are the numbers. These are the annual numbers, and you can switch to quarterly numbers. Are they going to hit these numbers? Because that's what's going to drive the share price in the next few years. And the question is, are they really going to grow from $400 billion to $465 billion? I don't know. I'm more downside than upside. But am I in the minority? Buy sell holds today for Apple. You got 33 buys, 17 holds, and 6 sells. That's not the unanimity that they used to have. They used to be like 48 buys and 1 hold. Like, that used to be Apple. The sentiment's got a little bit more negative. Don't get me wrong, I'm an eye sheep. I'm going to spend $1,500 on the iPhone 16 when it comes out. But Are there enough people like me? I don't know. That's what you got to figure out. That's your trading challenge. All right, those are the 6 scenarios. That's what you need to understand at a high level. Questions. Key value drivers. All right, so back to your Bloomberg Trading Challenge. Here's section 301. Here's where we are today. 1, 2, 3, 4, 5, 6. Good. Everybody is now participating. Here is the ranking of portfolio value. This is the team that's currently in first place. 31 trades. Wow. But they got 4% return. Everybody's in the black. And the good news is this is the one team, Elk Wolf. You got to be below 300,000. So buy something else between now and the end of the day. You still have 56 minutes before the U.S. market closes. You got to be 300,000 mean 300,000. So get below that number. All right, questions about the trading challenge? Still early. You got about 4.5 more weeks to go. This is how you're going to be scored. And by these results, I don't think anybody bought Meta Friday morning. You did? Oh, no. No other questions about that? All right. Final thing I want to mention is homework 3. Oh, certification. Certification due Friday night. Don't forget to do that. We're doing 5 modules now. Okay, got to make sure you do the 5th module, which is the Terminal Basics module. I was told by some people in the 11 a.m. section that they did the Terminal Basics module and it didn't give them a score. It showed they completed it, but it didn't give them a score. So show you completed it. That's going to be key to the 5th module. So apparently you could just kind of click through and be completed, so you can go through it pretty fast. I still recommend watching it because, as I said, the software's got a lot in it, and trying to learn it, the learning curve's pretty high. But regardless, make sure you do the 5 modules, those first 4 showing 70% or greater, 5th module that you completed it, turn that in, those screenshots by Friday, your certification. Questions about BMC? All right, homework 3 is going to be another EIC. It's going to be due on Monday, 10 a.m. This is still an individual assignment. Okay. Next week, I'm going to give you the group EIC project. So you're going to do group EIC as a group grade, as opposed to individual EIC individual grades. That'll be 10% of your semester grade for the group project. So that'll be the second group project that starts next week. All right. So second practice, the company that we picked today is called CBRE. Does anybody know who CBRE is and what they do? Yes.
The largest real estate company in the world, but they do a lot of like brokerage, and they also have CBRE Investment Management, which is one of the acquisitions and owning properties.
Great. Did you do an internship or something with them?
Final round, just didn't get it.
Okay. But you at least knew a little bit about the company.
Yeah.
All right. So if you don't know as much as he does about CBRE, DES is company description, and it will basically describe what he just said. And that's true for any company. So it's just a very useful feature in Bloomberg. Quick summary, what does the company do? DES. Okay, you can read all about them. But they're the largest, as you said, real estate firm, and you're doing the U.S. market for this analysis, the U.S. peers. But more importantly, they do mostly commercial, right? Commercial real estate. How's the commercial real estate market doing? Okay, so one of your screenshots, RV, custom spread. What do you think it's going to look like? Is it going to be a good spread? Probably not. So let's look at the spread of the industry. I'm not going to say the numbers because you're going to say that in your papers. But this is basically 1 screenshots that you're going to have to turn in. Okay? And it's a pretty fugly spread. Okay? And if you've never heard the word fugly, ask somebody. So the point is, why? Why is this market so awful? It's part of what you can be talking about your eye. I'll give you a start. What?
Less need for commercial offices and commercial real estate.
Why?
Remote work, mainly.
Yeah. Coming back out of COVID, people haven't gone back to working in the office. They're still doing a lot of remote work. And that's bad if you own a bunch of skyscrapers in a city that are sitting empty. Okay? And I'll relate a personal story. Yeah, go ahead. No.
I was gonna say also like short term,
And the cost of capital has been going up, which hurts real estate, which is a very long-term investment. But I told you I did a CFO gig in San Francisco from 2021 to 2022. I was running a Bay Area subsidiary of a healthcare network of Blue Shield of California, and we had 7 stories in an Oakland office building, downtown Oakland. Okay, and during COVID, no one was there. And the reason why no one was there in any of our offices was because we're a healthcare company, the doctors were like, no one can come in. So literally the entire company worked remote for like 2 years. All right. And as I was leaving, basically COVID winding down, we're like, we're gonna start going back to the office again. But we had 2 issues. One, our remote workers had actually scattered across the country and not told us. So we were having people who were making $200,000 a year in San Francisco that moved, one of them moved to like Nashville, Tennessee. And they were working remote, didn't tell us, making their San Francisco salary in Nashville and living it up, right? Same thing, we had people move to Oregon and Washington and Nevada and Arizona. They had no interest in coming back, and we had to make a decision, like you don't come back, you don't keep your job. And it was really ugly. But the second question was, even with the people coming back, we probably weren't gonna go back full time and fill up all the offices. What do we do with all the space? So we had 200,000 square feet of office space in downtown Oakland that we didn't want. So I think we were working with Jones LaSalle as opposed to CBRE, but the point is, we're like, go sublet it. Because we had a 10-year lease and we were like 3 years into it. We got the space right before COVID hit. Couldn't have been worse timing. But that was like all the buildings in San Francisco that were popping up. Now all those buildings in San Francisco are empty, and everybody's trying to lease office space, and most of them are empty. And rents have plummeted because that's the problem, is there's just a glut of commercial office space. Well, this is what these people are managing. Matter of fact, who's Cushman and Wakefield? What do they also manage? Malls. Why is that an issue? Yeah. What's happening in the malls? So what type of companies in the retail space have been disrupted? Sears, JCPenney, Macy's closed a bunch of stores. Those are anchors to malls. And the anchors go, so goes the mall. I was driving up to a friend's house in Allentown, and I was going up 83 north of Baltimore through Pennsylvania through Harrisburg. There's a zombie apocalypse mall right off the side of the interstate. It's really sad. I mean, it's just shut down. It's just an empty, deserted, grass is growing in the parking lot. There's nobody there. Like, it's a dead mall, right? Like I said, you watch about this in like the zombie movies, those are more and more malls. And that's the problem. Like, these are the people that are managing the malls. And matter of fact, I think Cushman, if I'm right, has a mall in downtown San Francisco, right on Market Street, that was very, very high end. And who closed? What was the anchor tenant that left? Extraordinarily high-end mall. Right near, what's that, Union Square? What was the store, anchor store that closed? Anybody know? Remember for San Francisco? Nordstrom. They pulled out because of crime, drugs, and nobody was going there because people were so afraid to go there because the crime and drugs had gotten so bad that retail traffic to that high-end mall plummeted. What do you do with all that space? Who are you going to sell it to? And the people that you want to sell it to don't want to go there, right? So you got all these retail problems to begin with. Got worse in San Francisco. And this is the deadening out of a lot of cities, right? And so that's the point. Like, this is some of the stuff you're going to be talking about. This could be any different in 5 years? That's going to be an important question, because that's what Mark's trying to figure out real time with these companies today. Anyways, have fun with this assignment. Learn about the commercial real estate market. That's on Monday. TAs have office hours next 2 days if you need any help. So guys, have a good week. If you didn't sign the sign-in sheet, please sign it before you leave.